So I'm going to ask Lou to come up, I'm assuming he's mic'd and ready. He'll be speaking about ICOs, STOs, decentralized business models, and the future of economic coordination. Thanks.
Thanks for joining my talk today. Apparently I've got to cut it a little shorter, so I'm going to try and get through as much of it as possible. Today I want to talk a little bit about ICOs, sort of 2017, 2018, STOs, which is kind of something which is a hot topic in 2019. And perhaps more importantly than just specific instruments, talk a little bit about decentralized business models and the economics and why we are at the edge of a dramatic change in the way that we coordinate economic activity. So we've been investing in this space for a couple of years now, and the good thing about that is it's given us exposure to a lot of different projects and made us think quite deeply about the nature of the technology and the different use cases and about how this fits into evolving technology themes and trends. And so one of the really important and obvious ones is this idea that every major computing cycle that we're building on top of has gone through an exploration and an exploitation phase. And so right from the beginning of the early days of computer technology through to where we are today, with highly centralized two-sided marketplace platforms, we find that industries and technologies go through these cycles. And so we're very much right now in the exploitation phase, dominated by a handful of online platforms, those being Facebook, Amazon, Apple, Netflix, Google. And to understand a little bit about their business models, they're effectively data plays. And so the more data they have, the more that they're able to refine their algorithms, which means that they're better able to create more compelling user experiences, which drives further user adoption. And one of the reasons why they've been able to grow so large and why it's so difficult to compete with them is that there are actually no barriers to entry, but it is exceedingly difficult to overcome the network effects that are the function of Metcalfe's law, of the more people that come into these platforms, the less use there is for a new user to go to a different platform. And so they've also been particularly good at taking advantage of something called aggregation theory. So in the past, what would happen is that vendors would have relationships with distributors. Distributors would effectively have relationships with end users. And so that was typically what that value chain would look like. But what aggregation theory tells us is that internet technology enabled that to be changed quite dramatically, because for the first time, one could acquire a new user at very near to zero marginal cost. You could provide content to a new user at very close to zero marginal cost. And it was as close to zero in addition to serve those new users. And so you had highly scalable business models where the more users came on board, the more profitable, the more difficult it was to overcome that kind of scale. And so if we look at Facebook, for example, it really is just a huge data silo that generates data internally and externally, aggregates that, and then enables advertisers to access that user base. Unfortunately, what has happened is that we've moved from what was initially a positive-sum game for all users to one which is very much a zero-sum game, where the platform providers are able to extract rent and are able to do so in a way which infringes not just on our privacy, but also, frankly, monetizes our data. And so it's useful to understand a little bit more about this idea of what are the economics around these kinds of networks. So effectively what we're saying is that there's a large group of users on the one side, there's a large group of vendors or advertisers on the other side, and that we've created a scenario where it is possible for a platform provider to insert themselves into that process and provide trust and control to that network, and thus intermediate between those two parties at relatively low cost and extract rent. And what decentralized networks allow us to do, particularly decentralized networks that are powered by blockchain technology, which is a super important component of it, is it enables us to create trust and control functions that are performed by different network actors rather than a trusted intermediary. And by doing so, what we're able to do is to create a system which is much more capable of distributing the economic surplus more equitably across network participants, and also able to do so at lower transactional costs than what is possible with the current decentralized or centralized networks. And to understand a little bit more about why it is able to do so at very low transaction costs, we need to look again at the theory of the firm, which is something that Coase came up with in the 1930s. And the theory of firm essentially says, if the market is so efficient at allocating resources, then why do we have firms? And what Coase found is that there are really three reasons, or three ways that firms reduce transaction costs compared to markets. And those are search and information costs, negotiation and decision costs, and finally, policing and enforcement costs. And to understand a little bit more about how that works in practice, we can use a very simple example of an entrepreneur who has employees, and the idea that information flows freely. There are a number of different employees that entrepreneur can ask to perform that task. Those employees have relatively little negotiation ability, so they're compelled to perform the task. And finally, that if they don't perform the task, or if they do it suboptimally, the entrepreneur can withdraw resources or let them go. So a much more efficient way of achieving those objectives without having to have a market do so. But what we found is that it is possible to use decentralized networks in a way where you can further reduce those transaction costs, even compared to firms. And then, in fact, this trade-off, which has typically happened, enables us to push out that efficient frontier when using blockchain technology in a decentralized architecture. And so we call that the blockchain coordination frontier. And effectively what we're saying at that point in time is that in the future we will find that things will tend to decentralize for as long as the coordination costs of a decentralized network are lower than the rent that is being extracted in a two-sided marketplace or online platform. And so to better understand, again, what those transaction costs would look like is that in a decentralized, for example, or decentralized network, the search and information costs are really just much lower because the information is publicly available in an immutable ledger, stays there kind of forever, can be accessed by anybody. On the decision and negotiation side, which is really a more, for example, price discovery in a decentralized network is something which is much more transparent, typically auction-based, or something which is embedded in software logic. And similarly so with sort of policing and enforcement, which is really just embedded inside a consensus mechanism, and once again, has very low specific transaction costs associated with it. So if all of this is happening, we have all this potential, then why are events like Facebook losing this much trust following Cambridge Analytica, why is it not leading to more and more people migrating to decentralized or blockchain-based solutions? And so we've already spoken about the value of network effects, but perhaps more importantly, and something which we haven't necessarily considered fully, is this idea that it is possible that blockchain is in fact one of those technologies that is not something which has a specific solution set which lends itself to end-user applications, but rather that it could just be a foundational technology which amplifies the effects of other emerging technologies. And really, it's about when you bring those two technologies or three technologies together that you're going to get highly, highly disruptive business models. And so let's talk a little bit about some of those business models, and they really just fit into three different themes. We're talking about resilience, trustlessness, and permissionless. And within that, there are different feature sets that enable us to do things in a very, very different way to how we're doing it today. And if you do an overlap of those three, what you realize is that it is not good enough to just have two of them within the current solution, because you wouldn't be taking advantage of the combined power of those three together. So for example, if you had permissionless without trustlessness, what you'd actually have is, what is that? Something that is insecure. And then if you had something that was permissionless and resilience, but it doesn't have trustlessness, then you're effectively talking about a database. And in each one of those cases, we have what we have today, unless you bring those three emerging feature sets of blockchain together. So in addition to the specific feature sets of the technology, it's also important for us to look at the overriding economics of blockchain or decentralized networks and why they enable you to overcome some of the very difficult obstacles for to overcoming centralized network advantages. And they're really, in the simplest form, we're talking about something here called a reinforcing loop or a flywheel. And the principle kind of in a simple form goes, user adoption drives traffic and usage, which drives user demands. User demands lead to more and more work for developers. Developers create those features, which in turn creates more user adoption. And that's kind of how it works in a more traditional sense. But if you have the ability to bootstrap network effects and insert incentives for behavior into that network, which is possible in a decentralized network, then you can make that wheel spin a lot faster, because suddenly you can, if you have developers that are highly incentivized, not just economically, but also in other ways, then they have skin in the game, and their ability to push out new features is much faster. So, which technology themes do we think are the ones that are going to lend themselves most to kind of these highly disruptive emerging business models? We think that IoT and distributed systems combined with blockchain are super powerful. Artificial intelligence, big data and analytics, augmented and virtual reality, digital commodities and encryption. And we think there are also specific sectors that are ripe for disruption at the intersection of these technologies. Some of those being finance, but also other things like digital native services, gaming, gambling, data. So, how long is this going to take? Is this going to happen next week? Why hasn't it happened yet? And our view on it is this is something that's going to probably take 15 to 30 years. That's the time frame we're looking at, yeah. And it's not going to happen overnight. We're going to have a gradual move from something which tends to be highly centralized in terms of technology stacks to something which becomes increasingly more decentralized from a technology and a business model perspective. And so we're moving over that period from something which is kind of where we are today with Web 2.0 dominant online platforms to the future, which is effectively these highly decentralized cooperatives which are funded by DAOs. And so in the current state, as I said before, we have this kind of mix between some open source and distributed technologies combined with highly centralized interfaces. And in the future, in the not too distant future, what we're going to see is this emergence of service businesses that are going to move businesses or industries that are predominantly centralized to ones that are increasingly more decentralized. And those services businesses won't necessarily be decentralized in and of themselves either. And so, for example, what is one of those services businesses that is making that shift? It would be something like a Luno or a Coinbase. But increasingly other kinds of businesses that enable that shift. And in the end state, we're going to have these, as I said before, highly decentralized cooperatives that are funded through DAOs, and we'll be able to do so in a way which distributes economic surpluses much more efficiently to the users rather than rent-seeking participants. So once again, there's this idea of a lot of people talk about, well, blockchain technology, why aren't we seeing more user adoption? If we have all these base protocols, why aren't we seeing more dApps? What's taking so long? Why are these things not being funded? And I think that even there, it's useful to understand here that these things go through cycles. So right now, we're very much in the base protocol development stage because building apps on top of current infrastructure is actually quite hard to do. So for example, last year, we had a situation where the Ethereum network was effectively unavailable to just about anybody else because users using a very small game were busy breeding cats. Now, clearly, that's not the kind of infrastructure that we need in order to build a truly decentralized world. So what happens after that is that once we get to a certain level of scale and capability at the protocol level, is it becomes increasingly more possible for you to do applications. And similarly, once applications have more demands on protocol, more and more development will happen at the protocol level. So it kind of switches between those two. And right now, we're just focusing on really fairly low-level technology in the overall tech stack. So what does that tell us about ICOs and STOs, and where do they all fit into this whole thing? And are we going to go through 2017 all over again with STOs in 2019? And our view on this is that it is really important for us to have both. I think that in 2017, we had this weird idea that tokens would somehow replace all these other kinds of instruments. So in certain cases, frankly, it was just, there was an opportunity to make some money and people kind of dived in there. But really what we found is that it's important not just to invest in early stage, at an early stage with something like a security instrument, which gives you certain rights and privileges, but that we are probably going, but then similarly, you need utility instruments in order to enable you to incentivize this kind of network behavior. So you need both. And the kinds of interesting instruments that we're seeing at the moment are ones that either start off as a security instrument and change rights over time programmatically into becoming utility instrument, partly because utility instrument essentially has no value at the point where the network is not yet at scale. But other kinds of instruments we've seen are ones where you might have a security instrument. Sorry, I should also just say that a security instrument, similarly, because it is ultimately a rent-seeking instrument, will have very little power in a decentralized network at scale, because it's really difficult to extract rent from a network at that point in time. So these things will evolve, and in certain cases they'll be about redemptions, in other cases they'll be about programmatic changes in rights and abilities. So we really are talking here about instrument types that take advantage of decentralization, trustlessness, and permissionless, but ultimately they are very much the same as the things we have today. They're just a lot more powerful when you use them inside decentralized networks. I think I'm out of time, so I was going to take you through some examples of some projects that we've been working on and how we've been applying these principles of decentralized network design. So maybe I'll just do the first one, because I have 2 minutes to go here. The first one is a digital identity marketplace called Civic. And the idea here really is that today we give up a lot of our private information, and frankly, we also have to redo and recreate these identities depending on where they need to be used, whether it's a bank account or a cell phone provider or buying a home or something else. And what Civic essentially says is that you have control over that information. You share that with whoever is requesting that information without giving up that information. So they won't necessarily know all of the information. They only know what is necessary in order for them to make a decision, and you can reuse that. And so one of the really interesting, powerful concepts or proof of concepts that Civic is doing in the US right now is the rollout of vending machines, and this idea that the vending machine doesn't know at the point that you're using your Civic identity that you are 43 or 23. But what it does know is that, and it frankly doesn't know who you are either in terms of gender or anything else, but it does know that you're older than 21. And I think that that's the principle of like reusable KYC. So in terms of economic design, the way that works is that it is embedded inside a decentralized network. There are 3 key network participants, which is the user, the merchant who wants to reuse the KYC, and the person who is able to attest to that information. And the network creates mechanisms for incentivizing behavior through rewards, penalties, and staking mechanisms for behavior which is really self-policing, in the sense that there is no arbitration function in the Civic network. There are no external data sources feeding information to Civic, and Civic can actually operate without incomplete or with incomplete information. And I think that it gives us a good indication of the kinds of things that will happen in the future. And if I have a couple of more minutes, I'll take you through another one. So another project that we're busy working on, which is really pretty cool, is an indoor football league that is launching in Las Vegas in a couple of months' time. And what's different and there are 8 teams, and what's interesting about it is that the entire league is entirely controlled by the fans. And so there is a pretty complex economic system which embeds that, which enables the fans to be able to make decisions at a league, at a team, and at a player, or even at a play level, because that's kind of possible in American football. But in terms of economic design choices, what we did is we used one of the really strong concepts there is this idea of token bonding. So there are a lot of utility instruments in that, as you can imagine, in that kind of network. Because what we wanted to do is we wanted to be able to not just isolate network effects, but we also wanted people who are participating in different parts of the network to benefit from the value being created in that part of the network. And so we used a principle called token bonding, which means that we have monetary units that have fixed relationships with each other. And so typically that would be a bad idea, because it would draw liquidity away from any one specific monetary instrument. But because these are all related to each other, they draw liquidity from each other as well, while still enabling us to isolate network effects and capture value. And so within the economic system of the FCFL, or the Fan-Controlled Football League, as I said before, you've got tokens that exist at different levels, and there are smart contracts that govern the relationships that exist between those tokens. And so from a user perspective, you're not even being exposed to the complexity of the economic system. But what you are able to do is to participate at an economic and at a reputational level in that entire league. And I spoke earlier on about the value of these decentralized networks and how they are so much better at distributing the economic surplus to the users. And in the FCFL, we have something called a reward function. And what this reward function does is to say, during a given cycle, we will reward people who have performed the following actions, which have the ability to create an increase in the network value, rather than who put the money in. And so what we say is, okay, these are the people that performed the actions over the cycle, and any new coins that are minted over that cycle are effectively distributed to the people that performed the actions. So the more you participate, the more you gain, the more you value or draw value from the overall increase in the network. So we're looking at a really strong and exciting 2019 and beyond. And I think that the opportunity in blockchain technology and in decentralized networks is absolutely huge. So I think we're all going to have lots of fun over the next couple of years. Thank you. We're doing Q&A.